I'm already joined by Mark Rakhmilevich and from Oracle, and he is giving a talk on aligning bank strategy and technical execution for tokenized money. He is Group Vice President, Product Management and Development of Digital Assets, and he'll introduce himself in a second, I believe. Mark, with that, I hand over the stage to you. Enjoy.
Thank you.
And give him a warm round of applause so that everyone outside knows we are live. Thank you.
Thanks very much. It's a tough spot right after lunch. I'm sure there are still, folks outside there, but we'll get started. So I'm happy to be here. Really thrilled to participate in the Digital Euro Conference. Thanks for inviting us. Oracle has been a core part of the financial ecosystem, a technology provided to many banks over the last few decades. For example, 24, 25 of, I think, out of 30 globally significant financial institutions are using Oracle technology in various forms, and probably, multiple hundreds of banks around the world. We have been involved in blockchain and DLT technology as well. For about the last 8 years, we have started with enterprise blockchain, first released in 2018, based on Hyperledger technology stack, and then evolved that to support digital assets more recently for the last 3 or 4 years. And I will share some of the learning, some of the insights that we had in working with central banks and commercial banks in this area, and a number of discussions about the challenges that they see in sort of coming up with the right strategy in this fragmented world of multiple forms of digital money, and how they can actually develop and deploy technical solutions that help them evolve across this kind of broad landscape. So, the landscape, of course, includes things like cryptocurrencies going back 10 years, and a number of banks are actually providing cryptocurrency custody services to their customers, which is a great, revenue source for some of them. More recently, we have seen tokenized deposits, tokenized securities, stablecoins, and in the central bank context, we've seen also CBDCs. We've been involved in some projects. One of the more visible ones has been in the Philippines last year, and a number of commercial tokenized deposit activities with some banks as well. All of those forms of money are generating interest, and for some banks, they have to decide which direction to go. Some may be providing cryptocurrency custody today and looking to move into issuance of stablecoins. Others are considering accepting stablecoins but not issuing their own. Others are still partnering around this space. For example, in Europe, 10, now 11 banks, I believe, have gotten together with this joint venture called Qivalis under sort of auspices of the Netherlands, trying to come up with a European stablecoin consortium, obviously, to counteract what's been happening lately in the US with the Genius Act and sort of the upcoming avalanche, we think, of US stablecoins. At the same time, we see projects around tokenized deposits. Here in Germany, for example, a very visible one is commercial bank money token, CBMT, with DZ Bank, Commerzbank, UniCredit, Deutsche Bank, and a couple others maybe joining as well. We're actually participating in this phase 2 pilot rollout. Yesterday I was in London talking to some folks about the Great Britain or UK tokenized deposit project as well. So this is a multi-bank environment where multiple banks getting together to do essentially either shared or exchangeable tokenized deposit, on one-to-one basis across a consortium of banks. There is certainly multiple benefits. I'm sure people in this audience are familiar with many of them. The 24/7 capabilities around payments and settlements, atomic trades, being able to do instant settlement without manual reconciliation, automation of various manual processes that can help avoid or reduce errors, real-time continuous asset valuation for previously illiquid assets, typical in real world assets, RWAs, reduce costs and time for cross-border payments has been a significant driver as well. So many of those benefits are visible, but the question is, how does the banks actually deploy solutions beyond pilots into production environment to make them real? Because of the fragmentation of digital money, many banks are actually quite concerned about the loss of the sort of deposit and credit franchise, right? Banks mainly are in the business, commercial banks at least, to take deposits and based on fractional reserve system turns them into loans, credit. Now, if the customers are going to, instead of those deposits, want to get stable coins, that requires one-to-one reserve. So a $100 reserve or bond, let's say, if it's treasury bond or whatever, allows them to issue $100 in stable coin as opposed to $700 or $800 in loans compared to tokenized deposits. So we see banks interested in moving with tokenized deposits because of this, right? It preserves the credit-making capability, but they do need to figure out how to move it from pilot stage to a production stage for those that have already been involved. And those that have not, right, how to actually create systems that support the stringent compliance, operational requirements, and the capabilities that will pass muster with regulators. As a payment instrument, tokenized deposits generally accepted by regulators as nothing significantly different from existing deposit structures. So in Germany with CBMT, for example, BaFin has essentially approved that as equivalent to existing cash deposits. It's only being recorded in a different manner, but that's just a matter of technical infrastructures that regulators are not particular about. But in order to do this, the banks have to figure out how to comply with all of the existing regulations. Regulations, KYC, know your customer, know your transaction, know your business, and many other things, sanction screening, AML, all of that, when it comes to implementing tokenized deposits. The opportunities are certainly significant there, right? They can deliver smarter financial products, faster payments, they can extend the regulated liquidity into this sort of a digital ecosystem world for their customers. But the question then becomes, should they go ahead with tokenized deposits or stable coins as well? The key difference, of course, the stable coins require one-to-one reserve. So you need to have a segregated reserve account capability versus a regular deposit DDA account against which you issue or mint the tokens. Then when you transfer them, the tokenized deposit cannot be transferred to somebody who is not a customer of the bank. So in the case of CBMT implementation, for example, different banks issue their own deposits as colored tokens. And then there is a conversion that happens, let's say, between one bank A and bank B token, so that bank B customer, when they receive a payment in a tokenized deposit form, actually holds bank B tokens that have been converted from payments that come in bank A token. Whereas with stable coins, you have full portability, right? And that's the biggest benefit of that. And then on the redemption side, of course, you have to deal differently with the reserves. The way that you settle those reserves, a stable coin, you basically have ability to reduce the reserve requirement one-to-one. Whereas if you're redeeming tokenized deposits, and in some cases, tokenized deposits can be redeemed transparently to the customer back to fiat, you simply have a credit back into the DDA account. Now, we think that for many universal banks, starting with tokenized deposits makes sense, both because the regulatory requirements are much simpler, it's a more controlled and more forgiving environment technically, and you can achieve significant benefits already in terms of atomic settlement, 24/7 liquidity optimization, automating treasury processes, and you can also leverage it as a strategic defense against your customers that are looking for some of the benefits of stablecoins in terms of faster payments, cross-border, and things like that. But there are limitations. On the other hand, with stablecoin and the upcoming avalanche, the banks have to make some decisions about what role do they want to play in the ecosystem. Do they want to be an issuer? And that means investing in the infrastructure and all of the regulatory approvals involved around that. Of course, it offers maximum control over their brand and the maximum benefits. But many banks are not ready to take that step, so they are looking to partner with other banks, maybe like, as an example, we have with 11 banks that are partnering on Q-Wallis. Or in some cases, they simply want to accept and integrate stablecoins for their customers, for their corporate customers who get paid in stablecoins, but they don't want to actually deal with the issuance side of it. Now, with tokenized deposits, there is an issue of fragmentation as well. So individual bank issuing tokenized deposit is going to be essentially working with their own customers. And if that customer needs to make a payment to somebody else who banks with a different bank, the tokenized deposit is not going to work because obviously, the KYC rules will prevent that. This drives the need for what we've seen as a multi-bank models for tokenized deposits. I mentioned CBMT. UK tokenized sterling project. There's a few others as well. We're participating actually with the CBMT banks in Germany in providing the underlying ledger capabilities. The goal there is to make it interoperable across multiple ledgers and to bring the token actually to whatever ledgers corporate customers, industrial companies are actually using to transact their business, particularly from supply chain perspective, right? So if a company has a significant investment in a particular blockchain for supply chains, they want the money to come to them. They don't want to have to deal with a separate ledger and integrating payments from the bank ledgers. They want the money to be there. And CBMT promise is that that can happen because of interoperability based on those tokens. However, even if CBMT project expands, there are some discussions into other countries within the EU and Euro world, there are still significant limits in terms of foreign exchange regulations, the jurisdiction requirements and limits of and so on. So we are going to see, I think, the emergence of a dual rail ecosystem with permissioned rails for tokenized deposits being broadly accepted in the next few years, and then public rails, of course, being used for the regulated stablecoins in the retail, cross-border, and kind of Web3 commerce. The value proposition, we think that going to really matter for the banks is liquidity orchestration across all of those. So that it's not just enough to be able to provide the instruments and transact them, but the banks that are going to win are those that are going to do the best at providing capabilities to orchestrate how money moves between these different rails, providing optimization based on various factors, and managing that liquidity transformation in a manner that's most transparent and optimized for the corporate customers at least, and maybe even individual retail customers. Programmable settlement as a service is going to be important, and then compliance as a service. Obviously, there is a new world of compliance coming, and providing a lot of those capabilities. We already see, for example, travel rule kind of things, requirements have to be extended. There is other things in terms of jurisdictional requirements, limits, sanction screening, etc. Providing that as a service on top of the blockchain rails, I think is going to be things that banks can monetize and make some additional revenue from. Now the question then becomes is what are the required technical capabilities for the phase one? In order to protect the core with tokenized deposits, of course you're going to need to have the underlying ledger capability, high availability, and resilience of that ledger. You're going to need to have access control, segregated capabilities around different roles. Banks don't want to have people who administer the system, administer the user accounts, administer and conduct the financial transactions all within the same roles, right? So detailed segregation of those roles, granular role-based access control, and ability to support then enforcement of that through the smart contract, ability to support approvals, what's called make a checker or 4ICE kind of approval requirements with attestations on the ledger are going to be really important. Core banking integrations, one of the things that has been really a big challenge for many banks is to try to integrate their blockchain infrastructure, those that have invested into it, and some banks have done a lot. A few of the larger banks in particular come to mind. But the challenge that they face, from what we understand, is integrating with existing infrastructure inside the banks, the core banking system, KYC, all of the sanctions required checking, and many others. In the case of one bank, I think they told us there were like 40 different internal systems they had to integrate with, and that's been really painful. The banks also, those that have tried to play in the space, have also seen some regulatory action, and there have been some fines imposed on some of the larger banks, which is not pleasant, because of the gaps between those systems opens the door to various concerns from regulators. We think deploying a solution based on permission ledger for tokenized deposits is also going to build the confidence within the bank to be able to then move forward with broader capabilities over time, right? But it gives you a sense of how tokenized money works, what kind of integrations need to be in place, how you operate, monitor, report, and so on in that environment. So it's an initial stepping stone that I think is going to have far-reaching implications. The second phase then is to look at a controlled stablecoin expansion. But the stablecoin expansion requires dealing with public chains. In a public chain environment, you have very adversarial situations, right? You have people that are going to try to break the rules. And you're going to need to provide, both from a technology perspective and operational perspective, a lot stronger capabilities. Geographic redundancy across highly available node infrastructure, much stronger key management using, multi-party computation or sharded keys, as well as, HSMs. They're no longer an option, they're mandatory in that kind of environment because, let's face it, in a permission chain, you always have a legal recourse. You know who the participants are, you have agreements with the participants, if something goes wrong, you can negotiate, you can take legal actions, etc. In a permissionless or public chain world, there is no legal recourse in most cases. And so you're going to have to depend on the technology to protect you. You're going to need to have stronger capabilities to protect against market abuse and financial crime, reporting capabilities, and so on. Continuous monitoring, particularly if your token is going to be issued across multiple chains, liquidity monitoring, redemption requirements, and the rate of exchange. And so all of those things are going to be much more stringent, require more technology. Now, with things, there is a conservative approach to stablecoin issuance, which is based on a hybrid model, where you can protect yourself against some of the risks by issuing the stablecoin initially on a permissioned ledger that gives you more control, more auditability, more ability to prove to regulators that everything's been done in a proper way, and maintaining kind of books and records in a permissioned environment, and then creating a ROP token for distribution on a public chain. And so this is going to basically create a representational model on a public chain of a token that was initiated on a permission chain. That gives you the benefits of preserving sort of more controlled environment for minting, for burning tokens. And it preserves some options where once you have an instrument that you can issue in a permission chain, you can decide when and how broadly to start distributing it using public chains and using roping. So, this is fairly straightforward. We know from cryptocurrency world, how roping world, you can essentially mint a token, you go through all of the approvals, all of the attestations, you can then lock it and remint it on another chain. On the permission chain, it remains locked in the vault, so it cannot be transacted or touched in any way. It can then go through various lifecycle stages as a ROP token on a public chain, and then when it's redeemed, it goes back and unlocked in the vault in a permission chain where you can then burn it and so on. You need to have some infrastructure in place for that. And we've worked with some banks that have tried to build this infrastructure. We know that it's going to take a long time. If they try to do it from scratch, there are significant development costs. Some people have spent billions of dollars. There are significant interoperability challenges because this world changes rapidly, literally on a monthly basis. There is new interoperability functionality that becomes available. Some of it's valid, some of it's not. And then, of course, you have to deal with all of the risks measures. You have to address confidentiality requirements. Obviously, financial privacy is very important, and public chains are not really set up for that. And, of course, the compliance requirements as well. Oracle has been working in this space for some time with unified digital asset infrastructure capabilities that we've been providing on the permission side and now bridging that into the public chains as well with the unified governance platform that essentially provides enterprise hardening for the open source technologies underneath, and at the same time creates institutional wrappers in the form of smart contract frameworks that implement various regulatory requirements and supervisory requirements in this world. That helps to provide faster time to market, obviously. So instead of spending years building something, you can stand it up in a matter of a few months and launch products and services based on those tokens, lower costs and risk, and improved operational discipline compared to sort of this fragment integration sprawl that some banks have had to deal with when they put together solutions from 5, 10, 15 different companies that provide specific point solutions, but not a unified platform. In the integration sprawl, you have to work as your own sort of system integrator, and a lot of things happen in those gaps that create risks and opportunities for breaches and so on. So our solution is focused on providing the core platform with multi-ledger capabilities, with Hyperledger Fabric and Besu, which is an enterprise Ethereum, with a compliance-focused smart contract framework, plus a reference token implementation for many forms of digital assets, from tokenized deposits, stablecoins, central bank digital currencies, bonds, and many others. Rich integration layer with API and eventing framework, and workflow-based orchestration. We provide universal wallet service that supports wallets on both a permission chain, but also with additional partitions for public chains. So you could have all of the assets and all of the different types of tokens managed within the same kind of overall universal wallet. And we've also been very diligently trying to follow the Bank Financial Settlements Unified Ledger principles in terms of interoperability, cross-ledger transactions that are atomic in nature. There is integration and acceleration capabilities in that space, including the workflows that I mentioned, streaming the data into Oracle database for post-processing, creating what we call rich histories that allows you to run anomaly detection, real-time supervision, regulatory reporting, and many other things, resilient transaction and workflow coordination as well. And then, at the database side, providing capabilities, leveraging GenAI, agentic AI capabilities to enforce the supervisory requirements, and then feed that back through the smart contract APIs into a closed loop environment where you can take actions on those. I'm going to pause here. I'm running short on time, but just maybe to go to the summary slide here. Actually, I just wanted to mention that we recently published an article in the DMI journal. There's also a lot of information on our blog, blogs.oracle.com/blockchain, where you can follow this up. And just in summary, we think that the bank should no longer wait for emergence of global standards. The time is now to start moving forward and launch pilots with tokenized deposit programs, particularly with some anchor corporate clients. Building interoperability is very important at the consortium level if you're participating with multiple organizations in order to regain this orchestration capability, orchestration authority, literally, over digital money in all forms. And this is sort of the recipe for banks continuing to anchor digital money within the regulated ecosystem, as opposed to letting it escape into the unmanaged fintech world.
Thank you, Mark. Oh, thank you, Mark. Yeah, I think as tokenized money moves from concept to implementation, a practical yet strategic and well-reasoned perspective like that from Mark is invaluable. Thank you a lot.